So as Ian said, I'm currently the head of investor relation efforts, and I'm also part of the business development team looking at strategic alternatives for our business. So thank you, Ian. With that, there is our forward-looking statements here. You can find these on our website by downloading the presentation at semlerscientific.com. So I wanted to start out with some high-level points about Semler's business model and why we think it's an interesting investment. We're a diagnostics medtech firm. Our disruptive technology brings testing for peripheral arterial disease, or PAD, and other cardiovascular testing to the front lines of medicine. Our distribution model is highly leverageable with a large account sales team focus where we sell to health insurance plans, health risk assessment companies, and other emerging customers such as delegated medical groups and retail health clinics. Unlike traditional medtech companies that simply sell their hardware on a one-time basis, we have a recurring SaaS subscription licensing model. And finally, we have a large and underpenetrated TAM. We've had over 4 years of solid growth and profitability, as well as strong cash generation. We aim to be a software and products platform, providing solutions that are faster, more practical to use, more accurate, and less expensive versus existing technologies. Quantiflo is our main product, and it aids in the diagnosis of PAD. The Quantiflow Extension targets diagnosis of another cardiovascular disease. So based on the American Heart Association and American College of Cardiology criteria, we believe that there are more than 80 million people in the US that could be tested for PAD. And PAD is a condition where the arteries serving the extremities narrow and reduce blood flow. PAD often has comorbidities such as heart failure, diabetes, and renal failure. Over 30% of patients over 65 screen positive for PAD, yet it's highly underdiagnosed as 75% of patients are asymptomatic. So those with PAD have a 21% increased risk of heart attack, stroke, hospitalization, or death. The comorbidities and PAD result in significant annual costs to the US government. So there is a need for a cost and time-efficient means to identify these at-risk patients that are unaware of their status. It's important to get testing done early, even before symptoms may present, so that patients can start preventative care to avoid severe outcomes that could lead to higher costs down the road. As with clogged arteries in the heart, clogged arteries in the legs place patients at an increased risk of heart attack and stroke. Published studies have shown that persons with PAD are 4 times more likely to die of heart attack and 2 to 3 times more likely to die of stroke. Preventative care can help with improved economics to mitigate the financial costs of chronic diseases. The Quantiflo diagnostic test involves a simple sensor that's placed on the finger or toe and relays data to the Quantiflo software running on any PC, laptop, or tablet. It's pictured here on the left as the green clip. It's patented and FDA cleared. So infrared light emits from the clamp on the dorsal surface of the digits, is scattered and reflected by the red blood cells coursing through the area of illumination. Returning light is sensed by the sensor. A blood flow waveform is instantaneously constructed by our proprietary software algorithm. The test takes less than 5 minutes and can be performed by a non-specialized clinical aide, making it perfect to bring testing to the front lines of medicine. Clinically proven and accurate test results are immediately available to the physician, and the test report can be placed in the patient's record. The Quantiflow extension will use the same device and can be pushed as a software upgrade. The competition for Quantiflow is traditional ABI testing, which has been the standard of care for decades. There are several companies that manufacture the traditional ABI device, which range in price from $2,500 to $20,000. The ABI uses blood pressure cuffs and Doppler ultrasound imaging. It requires a trained vascular technician and is performed by referral in a specialized lab. It's more expensive and time-consuming with accuracy that is less or the same as Quantiflo. So these hurdles have meant that historically, asymptomatic patients have not been tested. Our customers primarily serve the Medicare Advantage member population and include health insurance plans and HRAs, as well as emerging customers such as delegated medical groups and retail clinics. This customer base is quite concentrated. On the Medicare Advantage side, the top 5 plans represent around 75% of the Medicare Advantage member base. On the HRA side, the customer base is concentrated as well with a handful of companies. We believe we offer high customer value proposition in 2 ways. First, earlier detection leads to more appropriate treatment of affected members so they can have healthier lives, which may mean lower costs to our customers. Second, the ability to close the gap between cost of care and compensation of care. So by detecting patients that have PAD, Medicare Advantage plans and other value-based players can receive an additional risk adjustment payment, which ensures our customers receive appropriate compensation that could help offset the likely higher cost of caring for these patients. So our primary TAM includes 80 million people in the US who could be tested under recommended criteria, which is those people 65 or older or age 50 to 64 with cardiovascular risk factors. Of these 80 million, there are 20 million that are Medicare Advantage members who currently are our primary testing targets. So there are demographic tailwinds as well within our business opportunity. The Medicare currently serves over 63 million people. And as I just mentioned, of these 28 million are enrolled in Medicare Advantage plans. Medicare Advantage enrollment has doubled over the past decade and continues to grow. An aging population is a further tailwind with 10,000 people turning 65 every day in the US. In addition to favorable demographics, we believe a recently published study by a large customer will drive further adoption to new and existing customers. The data published underscores the benefits of using Quantiflo on asymptomatic patients. We refer to the publication as the Nevada paper. We're currently introducing the data and findings of the Nevada paper to existing and potential clients, which we believe will support our goal of having Quantiflo become the standard of care. So this was officially published in June 2022 in the Journal of Vascular Surgery. The Nevada paper was an independently conducted, peer-reviewed study that used Quantiflo for the screening of undetected and asymptomatic PAD in a Medicare Advantage population with 3-year follow-up. There were nearly 14,000 asymptomatic patients that were tested, and over 30% of them were found to have PAD. In positive versus negative patients, there was an increased risk of 60 to 70% for all-cause mortality or morbidity after a year, and 40 to 50% increased risk at 3 years. A positive PAD screen with Quantiflo has the potential for PAD risk management, which I talked about before. We believe the study supports the use of Quantiflo and highlights the benefits the product brings to our customers and the patients they care for. Thus, it may drive further adoption by new and existing customers. A link to the publication can be found on our investor relations portion of the website under press releases. So looking at our customer base, and I think one of the differentiating factors of our business model is that the Quantiflo generates recurring revenue under a SaaS model. This takes 2 forms depending on the customer. Around 60% of our revenues are fixed fee revenues, where customers are charged a recurring monthly fee for unlimited testing usage. Customers generally include Medicare Advantage payers and other value-based players. Because these customers are able to receive an additional Medicare Advantage risk adjustment payment on positive patients, they could break even after only performing 10 tests because typically 30 patients are test positive. The second form of revenues, which is roughly the remaining 40%, are variable fees. Under this model, we sell the devices for a nominal fee and charge a fee per test. HRAs are the home risk assessment companies, typically fall under this fee structure. And the HRAs themselves are contracted by the Medicare Advantage payers and other value-based players to perform in-home assessments on their members that have not otherwise had an annual exam, which is required every year. It's also important for them to get this annual exam because on an annual basis, the Medicare Advantage payments are zeroed out and all risk factors are removed. So it's important to have these done and the risk factors included every year. The HRAs actually get paid an additional fee for each test they perform by the Medicare Advantage payers. And so it's making Quantiflo an additional revenue generator and margin enhancer for them. We've seen that our product is very sticky, resulting in high customer retention because in addition to the return potential, we offer various levels of enterprise solutions, including EMR integration. We have the opportunity to introduce new synergistic products that have recurring revenues and are sold through our same sales channel. One such product is the recently announced product, Quantiflow Extension. So the Quantiflow product extension was developed through our own internal efforts and will expand the market to identify patients who would benefit from further evaluation for another underlying cardiovascular disease. We believe this extension may make it even more valuable to assist the medical community in the future, including Medicare Advantage providers. It will serve our current customer population TAM. We're awaiting the publication of our data in a peer-reviewed journal before announcing the underlying cardiovascular disease. Although we haven't announced what this is publicly, we are able to start speaking with our customers about this under NDA. And as of the last quarter, we're far along in discussion. The end of last quarter, we're far along in discussions with a handful of customers. The product extension does fall under our current FDA clearance status. And as I mentioned before, it uses the same hardware and can be pushed out to our customers with a software upgrade. The new product is, another new product is Insulin Insights, which we have distribution rights to. Insulin Insights is an FDA-cleared software solution designed to provide optimal insulin dosing recommendations. It will be sold on a PM basis or per member per month and sit on the desktop or laptop of primary care physicians. The primary benefit to our customers is getting A1C levels within an acceptable ranges quicker, which can lead to lower hyperglycemic hospital admissions and lower use of non-insulin related drugs. We're in early beta launch with several smaller customers on Insulin Insights. And lastly, we have an equity investment in SynapseDx, whose product Discern is a test for early Alzheimer's disease. So as I mentioned before, we've had over 4 years of solid growth and profitability, and we have a strong cash position, which was $40 million at the end of June. Our SaaS model results in high gross margins, which were 93% in the first half of this year, and high operating margins, which were around 32% in the first year. Annual free cash flow, as Ian had mentioned in the intro, was around $17 million in the last 12 months. We've reported $28.8 million in the first half of fiscal 2022, representing 5% year-over-year growth. We expect revenues will accelerate in the second half of the year, and will grow in a range from 14 to 21% over the prior year, leading to annual revenue growth of 9 to 14%. We see customer interest in the product increasing, and the Nevada paper should support growth. Into next year, the extension of Quantiflow and Insulin Insights should support further growth, but we have minimal revenues from those two products included in our expectations this year. So finally, I'd like to end on our capital allocation priorities. As I just mentioned, we're in a strong financial position with over $40 million in cash and no debt at the end of Q2 due to strong operating cash flow and minimal need for capital investments. Our capital allocation priorities are to maximize shareholder returns. We'll first look to reinvest in the core business by further establishing Quantiflow as a standard of care, by adding additional customers and investing in Quantiflow upgrades and new products. Second, we look to diversify our product range over the long term through either acquisitions or additional licensing agreements. We expect any of these types of capital allocation priorities would be more tuck-in of nature, not transformative. And lastly, share buybacks would be our last priority for capital allocation. We announced a 20 million share repurchase program earlier this year and had 17 million in the authorization available as of the end of June. So thank you for your time today and interest in Semler. If you wish to speak further to me about Semler, I can be reached at rcormier@semlerscientific.com. Now I'd be happy to take questions.
Yeah, thank you, Renae, for the presentation. Maybe the first question I would have, and you spoke so eloquently about it as a lead into your presentation, you first sat on the investor side, kind of externally with Semler, and now you're sitting internally with the company. So, I obviously don't expect you to share any of the skeletons in the closet or bad things. We'll stick to the good things. I'm curious what you think investors don't fully appreciate or understand about the company, now that you're internal there.
Yeah, sure. I actually get asked that often. People ask me the internal view versus external view, which I had before. And one of the things that I actually often point to is, as an external investor, and you know this as well, we didn't really have a lot of access to anyone in the company beyond Doug or Dennis, right? So we'd be able to talk to them periodically throughout the year. But what I found is, Doug is a really impressive leader. He has a very nice leadership style, is very involved within the business. I talk to him nearly every day. And then beyond Doug, we have a really strong senior leadership team as well. And I've really enjoyed getting to know those people. Many of them have worked with Semler for over a decade. And some, in fact, have worked with Doug at prior companies that he has been at. So that's definitely one of the things that I've noticed or come out with.
No, thank you. Mike, do you want to ask a couple questions from the audience?
Yeah. Is there a need for regular PED testing, or is it just a once-in-a-lifetime measurement?
Yeah, so there would be a need for regular testing. And while it's recommended that it's done every year, in reality, what we are seeing is that it's done less frequently. Many of our customers, some will test people every year, but some will test every other year. And then if someone is positive for PED, the testing intervals may be even longer than that, maybe every 3 years. But the PED test does come back even on positive people on a graded basis. So there's 4 levels that'll come out with for mild, no PED, mild, medium, or severe, so that the test can also let the doctors know the progression of the disease or if the preventative measures are actually helping.
So the questioner asked, so stated that the company has historically mentioned that they're underpenetrated in peripheral artery disease, but growth has been declining since like 2018, where the questioner says it was 73%, and the current guidance calls for 11%. So the questioner wants to know why has there been such a significant decline in revenue growth?
Yeah, sure. So we get that question a lot as well, and a lot of people phrase it as, "Are you fully penetrated in your TAM?" So I'll start with, uh, one perspective on the TAM penetration. If you just look at the smaller TAM of 28 million people under Medicare Advantage plans, we think our annual testing numbers lead us to around a mid-teen penetration of the population of TAM. From a revenue and customer perspective, so we do disclose our top 2 revenue customers, right? And so you see that we're very concentrated within those. But within those, we do still think that we have some penetration left and we aren't fully penetrated. I think going back to Ian's other question too, what maybe I didn't really have an appreciation for on as an investor within the company was just how complex the Medicare Advantage organizations are. And so when you look at the top organizations, the top 5 are about 75% of the market. Even if you look within the largest one, United Healthcare, they actually are a very large organization. They're about the 7th largest company in the world, really, but they have very different ways that they work with their customers as well. So and even their doctors. So some doctors they own some delegated medical groups, which is it's very easy for them to tell these doctors because they own them. They buy the unit and they place them in the doctor's office. Other primary care physicians, they work with many payers. So while they're encouraged to have these devices, the healthcare plans can't, make it mandatory for them. So just penetrating within our existing customers, does take time. And also, if you look at the top 5 Medicare Advantage plans, we are in some customers, but not others. So we do have some future ability to gain new large customers and also continue penetrating within our current customer base.
Can you share the thinking on why the share repurchases weren't pursued more aggressively given the recent low prices and resilient balance sheet?
Yeah, so we did repurchase 3 million last quarter. In hindsight, it turned out that it was a good price. One of the things that even though we do have around 40 million on our balance sheet, as I mentioned, besides internally investing in our business to grow, we really do want to be a multi-product platform. And so we want to make sure that we have the optionality in the cash on the balance sheet should we find good opportunities for companies that we can either acquire or partner with. And so that's one of the really important priorities of management.
Another question we had is one of your largest customers, Signify, was recently acquired by CBS. What opportunities or risks does that present, Semler?
Yeah, sure. So obviously, any change presents risk. But how we're looking at this is Signify is currently owned by a private equity firm who, by definition, is not in the healthcare space, right? And may not have the same goals as Semler has. In the hands of CBS, as it turns out, or another healthcare provider, obviously CBS owns Aetna, but we think longer term, the goals there are much more aligned with ours. And within there, as well. We can say that we are a nice revenue and margin generator for Signify. So to the extent that they, look at that, that's positive. One of the other questions that we often get asked related to that is, if you look at Signify, who obviously is a public company, so you have all of the data there. They do disclose their top 3 customers. So it's Humana, Aetna, and United Health. And we get asked, well, why would the other payers want to stay with Signify if now CBS, who owns Aetna, owns it? And one of the things that we can point to in the past couple of years is CBS did buy Primark, which is a PBM, and that's a multi-payer PBM. And even after all this time within CBS, it has continued to be a multi-payer PBM. One of the things that CBS did was they had a conference call on the day that they announced this acquisition. And they did say that they are going to run Signify as a standalone business. And so the Signify management team is coming over with the business. Now, if you look at it, it's very small versus all of Signify. So they did say they aren't planning on keeping it as a separate reported operating unit because it is so small. But, at the end of the day, if other payers decide they don't want to be at Signify, the good news is for us, I think the HRA industry is very concentrated as well. Now, Signify is the largest. It's going to be hard in the near term for any payers to move to other HRAs. It could take a lot of time. But we do have relationships with most of the top HRAs out there. So if a customer were to switch from Signify to another, we would likely keep their business because we are with other HRAs.
Okay. No, thank you. Another question we had was, what are your plans for future clinical studies in the value of early detection of PAD and the use of Quantiflo?
Yeah, so at this point, we don't have any plans for any further clinical studies. One of the, obviously I mentioned earlier, the Nevada paper, which was done by our largest customer. We really think that study is very significant since it was 14,000 people and spanned over a 3-year time period. And, as I mentioned, we are currently getting that out to our current customers. So we think that is a significant study.
Okay. And another question I had was the extension of Quantiflo that you mentioned in your presentation. Is there a way that you can kind of size up that opportunity? Is it comparable to PAD, or how should we think about that?
Yeah, I think that it will be the same patient population that could be tested for that.
Okay.
Yeah, and within there, like I mentioned, for the payers, it could be as valuable of an additional risk adjustment code to them. But one of the things, again, as I'm realizing here and how kind of slow moving this healthcare space is, even though we're selling it to our current customers and we have a relationship with them, it's something that they likely will be wanting to initially pilot on a smaller population within their organization. And once they do the pilot, they will need to figure out, okay, what are we going to do with these patients that test positive? Do we have enough resources? Because they don't want to overwhelm their healthcare system and infrastructure. And then they also have to make sure that they have proper protocols for what happens next to these positive patients, what preventative care, what medication, because you can't just have someone that tests positive and then do nothing with them.
Another question came in. Are there pricing discounts for higher volume customers as they use Quantiflo more?
Yes, there are volume discounts for customers that have higher volume. We don't like to talk about that really on our earnings calls because of the ability of other customers to be on the call. We don't want customers to say, okay, well, where's my discount? We do have a customer on the variable fee side that did reach a volume discount during the quarter in Q2.
Okay.
And we don't expect that there will be a lot of these milestone volume discounts, but that's going to be rolling through.
See, the last question we have, or a couple questions. Can you tell us why you're so excited about the new internal cardiovascular product? Compare how you will market it to your customers versus the core Quantiflo. What kind of reception are you seeing from existing customers if they're piloting it?
Yeah, sure. So, we are excited because this is another significant cardiovascular disease that, if we can identify patients early that are asymptomatic, then these patients can be treated earlier, which helps their obviously in more mortality and morbidity, right, of these patients. And we will be selling this through our same sales force, through our same sales channels, because it is targeted at the same customers. So it will be targeted at the Medicare Advantage plans, the payers, delegated medical groups, and then also within the HRAs.
Okay. And we do have another one. Are you seeing any interesting M&A opportunities given the state of the credit markets?
Yeah, so there are several opportunities out there, and I've looked at many since I started actually earlier this year. And one of the things that is important to us is that it goes through our same sales channel, because we don't want to buy a company and get in a situation where we have to change our sales motion. So it's important for us to get some leverage out of that. It's also important to us that, it's the same customer base, right? The Medicare Advantage plans or the HRAs, and that also it provides value to the customers. It may not necessarily be value in additional risk adjustment payment, but it could be value in cost, saved costs down the road, which is similar to what Insulin Insights is.
Okay.
And as I mentioned too, we're not looking for a transformative acquisition, but it will likely be more of a tuck-in.